We were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. We are having so much fun with this podcast because we're helping real estate investors and real estate educators. So if you like what you hear, maybe even if you don't, please help me out. We're trying to get more information to more people. Give us a 5-star review and share it with a friend. I have a very special guest with me today, someone I've known for a long, long time, although we don't talk all that frequently, Tracey, but I could tell you this. He is one of the best speakers we've ever had at any of our events. So I'm definitely going to have to invite you back out to another event to get you up on stage again.
Thank you very much.
20 years, Tracey,
20
in
plus
the
years.
business.
That scares me. That's a long time.
20 years in the 1031 exchange business, helping real estate investors. But before that, traveled, sounds like, all over the world as working in investment banking. And it's interesting, you didn't know this, but when I was in, I worked for a company called Murray Hill, who was acquired by Clayton Holdings and ended up going public while I was working there. And what they do is they analyze mortgage-backed securities or mortgage bonds.
Oh,
and
like
Credit
Trepp
Suisse
Systems does.
was, I think it's how you say it, Credit Suisse. Is that how you say it?
Yeah, exactly.
That was one of my clients. So I would analyze mortgage bonds for that bank. And that's one of the companies you worked for. So we have something in common we didn't even know we had in common. So Tracey, welcome to the show.
Thank you. That is a very unique deal. Investment banking, is not a huge, we're separated by 6 degrees. And for 20 years, I didn't know that about you. That's awesome.
So I was, this was back in 2000, I guess it was 2005. And I was starting to struggle a little bit as a real estate investor. I started investing in 2001 and it was just getting tough. So I was looking for some extra income.
Yeah.
So I decided to use my degree and I went out and I got a job working, I guess, in Wall Street, analyzing mortgage bonds. So I did that for a little 2-year stint.
Were you doing that here in Denver or back in New York or where?
Yeah. So your background here, you that cash register building there, that Wells Fargo Center?
Yeah, that's where my Merrill Lynch office was when I worked for Merrill. So I worked for Merrill in Denver and then later on in Hong Kong and Sao Paulo, Brazil. Basically did fixed income and M&A work, mergers and acquisitions. And prior to those number of years, 7 years, I was with Credit Suisse First Boston, like you mentioned, out of Zurich and London and New York. And I was an economist with the risk controlled arbitrage group. And I did do the cash flow engineering, the waterfall engineering, you know that term, on mortgage-backed securities. So,
that's funny. I wonder if we were touching the same bonds. Maybe so.
Yeah, electronically, of course. Okay.
Yeah, so we were doing all subprime. So everything we were analyzing was subprime stuff. So it was, and obviously this was 2005 and 6, so leading up to 2008. And I hear people tell me
later than me. I was there prior to that.
Okay. So I was working in that same building, though. That cash register building is where our offices were. And I get people ask me sometimes, like, did you see this coming? Because I was in the trenches. I was analyzing the bonds that took the economy down, and I didn't see it coming. So people tell me they saw it coming. I'm like, I don't know how.
Yeah, you may not be working at Pine. You would have been wealthy if you could have really seen it coming.
That's right. All right. So you worked in investment banking, some fixed income stuff, it sounds like. What got you into 1031? So take me back 2 decades. How'd you get going?
Okay. Really, to make a long story short, it was a lifestyle change. I wanted to come back home. I did an awful lot of travel. 1 year, I think I did 270 days of travel. That's an awful lot of travel. So a lifestyle change. Wanted to come back home to Denver. Not a lot of investment banking per se in Denver. It's got some, but not. So all that, actually teamed up with another guy that wanted me to come on board with him in terms of capital and everything, and started doing 1031 exchanges. And after about 6 or 7 years, Fidelity came in, bought the company, and that's how I've been doing exchanges now since 2009 here at IPX, Investment Property Exchange Services, Inc. You can see with a mouthful of a name like that, we're trying to just shorten it up to IPX 1031. So it's a very good company. I love it. It is the largest qualified intermediary in the country. So there are 30 some attorneys. There are including exchange coordinators and the banking staff. We're about just under 200 full-time people. We're wholly owned as a subsidiary of Fidelity National Financial, FNF, New York Stock Exchange ticker symbol. It is the mothership that owns Fidelity Title, Chicago Title, Commonwealth or Heritage Title. We own Ticor Title, Lawyers Title, Alamo Title. That's a big deal down in Texas. Security Union, a security title out of New York and New Jersey. So if they're left standing in the title world, our mother company keeps trying to buy them up. So we're very large. Let me do just a smidgen more bragging because it's so recent that I want it to be fresh because I may not get to brag after this year. Nationwide, we did about 23 billion with a B dollars worth of 1031's.
Wow.
And that's just the sale, the exchange or the sales, net sales proceeds we're holding. So the actual value of the real estate probably was about fourfold that number.
That's
In Colorado,
amazing.
it is. Here's what's amazing. I never thought I would do in Colorado. So I cover Colorado and Wyoming. $1.3 billion in 1031 exchanges. That just is a mind-numbing number, but it made for a good year and it makes for some good bragging rights. But we'll see what happens in the upcoming years.
Yeah, and we're going to get into it in a minute, but that much volume and that much business, you've probably seen it all. So I'm sure we could learn something from you and some of your experiences, maybe some of the mistakes that you see investors making.
I don't make any mistakes.
I'd love to get into that. I don't want to go too fast over your background here because it is interesting, and you obviously have a lot of education and a lot of qualifying to do what you do, and all the investment banking and everything. But you're a teacher also, so you teach at Regis, is it?
Yeah. So I have an undergrad in finance and engineering, and then I got an MBA. My dad was an engineer, civil engineer. My kid, one child, is an architectural engineer. My dad says I ruined a perfectly good engineering degree by getting an MBA. But then later on, I'm working on my master's in accounting, and he says, "You've redeemed yourself. You're okay now." And with all that, I do a little teaching. I've taught at Regis University. They had me teaching economics, statistics, comparative economics, accounting. But mainly my teaching now is done through IPX, and I go out and I teach residential brokers, commercial brokers, tell them about all the 1031 part of the tax code. I make it interesting and lively. I even do a class called Barstool Economics, and it's just about all the proposed tax changes that are coming at us and how we should, how it's going to impact us in the real estate world.
Okay.
Yeah.
Well, I'm hearing about some of these changes, and I know that we have the corporate transparency that just came in. And then I just learned today, Tracey, about another transparency act. I can't even tell you what it's called, but I guess the government wants to track transfers of real estate now. And you have to, even if you quit claim deed it into an LLC, you have to register that. Have you heard about this?
I have heard about it. I am not familiar with all the details.
It's just proposed.
But you are right. It's just, yeah, the IRS is, the government, the IRS is indeed keeping their thumb on us all.
It's pretty amazing. It's pretty amazing that it's being challenged. Like the Corporate Transparency Act has been challenged and it has lost in court. So there's an appeal in process, but we'll kind of see how that plays out. But yeah, and it's kind of an invasion of privacy. And this obviously has nothing to do with 1031, so I'm going to move on. I just thought about it.
A little bit it might. I mean, for example, let's take somebody that owns a property that they're going to sell. I don't know, single family rental property, or maybe they own a big apartment building, and they own it in an LLC, and it's a single membered LLC. And they're going to sell, they're going to do the exchange, and the property they're going to buy, the replacement property, the lender is sort of giving them fits because they're being told, oh, you're doing the exchange in the LLC, but we need to have the loan to you, Mr. Taxpayer, whoever that is. So it is okay for a single membered LLC. It's treated for federal tax purposes as a disregarded entity. You know that.
Yes.
And that means he can buy the replacement property, satisfying the exchange, and being okay with his lender, he can buy it in his individual name. So this idea of taking something out or putting something into an LLC, yeah, that it's very germane to the what the law that you're just talking about that they're trying to change.
Well, as real estate investors, Tracy, you know this better than most. We use LLCs, we use trusts, we use these
Yeah.
different entities for asset protection, for privacy issues, for tax planning,
That's right.
estate planning. There's lots of reasons to use these different entities. So for the government to come in and who knows if it's going to pass? I'd be surprised if it did, honestly. But for them to come in and try to control that, it's a little bizarre.
I would put it somewhere at paranoid. Yeah, I'm not in agreement with it either. But again, I don't know all the ins and outs of the law or proposed law. But after this, you know what? I'm so curious. I'm going to go
You're gonna
dig
go look
more
for
into it. Yeah.
Okay.
Maybe I'll add it to my Barstool economics presentation.
There you go.
So
All right.
thank you
So
for
you are a whiz at the economy. That's one of the things I love about your presentation. So before we get into the 1031s, I do want to
Thanks so
just
much.
touch on this because we have a lot of confusion in the economy right now. We have high inflation, we have
Yeah.
high, strong jobs, and we have a Federal Reserve that's trying to, with a dual mandate, yeah, and they're trying to figure out how to manage this. So we're told, and they actually just said again, they're committed to the three, basically
Rate cuts this year.
they're committed to
Yeah.
the three rate cuts.
So
Now,
we
they
have
didn't-
6 meetings left, and they're going to
right,
do 3 cuts. That's what
and
they say.
and in an election year,
Oh yeah.
and in some, I mean, there's multiple ways to look at inflation, but in some of the matrix, inflation increasing. So
Yes.
what in the heck is going on?
Well, I don't know all the ins and outs. I don't have that magical ball. If I could, I'd be making even more money. But do I think that the feds are going to have 3 rate cuts this year? Maybe we'll try that angle. What was it? Yogi Berra said that, don't try and predict the future if it's happening before now or something. I don't think they're going to be able to do 3 cuts.
I don't know.
They do
either.
have 6 meetings left, Federal Reserve board meetings where they can raise the interest rates. If there are cuts, I think they'll be somewhere in the late 3rd quarter to maybe 4th quarter, if there are going to be cuts. And I think 2 at the very most. So I don't want to dash anybody's hopes out there, but I think that's a lot more realistic. Why? Because inflation is still here, very, very sticky.
Yes.
And if by some measures, like you just said a minute ago, it is actually going up with the Francis Scott Key Bridge going out and the Baltimore, that entire supply chain to the economy is going to impact the entire GDP. And I think that's going to be worse for inflation. So I think if anything, we have the risk to the upside for CPI. And the economy seems to be doing pretty well. For
Really
those of us
well.
in the for those of us in the real estate world, we're sort of like in a weird Goldilocks type of deal. I mean, real estate prices, residential particularly, are very high. But most of that is due to supply issue problems. We're just not building enough houses, enough single family units out there to at all begin to bring down prices. So prices are going up, CPI, inflation's going up. I just don't think there's going to be 3 rate cuts this year.
Yeah, I agree.
Boy,
with
I
you.
hope I'm wrong, but
Me too. Me too.
Yeah.
And by the time this airs, it's actually going to be airing in May, likely.
okay.
So we'll be down another meeting. So I don't know what's going to happen in May, but quite frankly, there's not a lot of data between the time we're recording this, which is the end of March, and early May when that meeting is. So I don't know that they can do anything then. So I don't have a crystal ball either, right? But
Yeah.
I would be surprised if you see any
Well,
movement.
you and
in
I are
May.
sort of thinking alike, so that's okay. We're simpatico.
Yeah, I agree. What I do find interesting is real estate on the residential side has been the darling of the economy. It continues to surprise. In fact, I think we have according to Redfin, an annual increase of a little over 6% year over year in housing right now.
Mhm.
So, I mean, that makes it hard to bring inflation down when you have one of the biggest, almost, I mean, over a third, right, of the inflation numbers is
Inflation.
housing.
Yeah.
So what I see happening here, Tracey, is a good time to sell housing, residential units, and maybe a good time to buy commercial, because commercial, quite frankly, is struggling.
Yes,
I mean,
it is.
we've seen some asset classes lose 40% of their value. So
Yep.
if I'm a real estate investor and I'm
You're
looking
talking
at,
about office.
yeah, that's the one.
Yeah,
But
yeah.
multifamily is not far behind.
Not doing, yeah, that's right. My colleagues in California, multifamily is still doing outstandingly well. Maybe not as good as self-storage, but in Colorado, you're right, multifamily is a hurting unit.
Across the nation. I mean, we see northern California and New York. Those are the two that are coming to mind. There's some significant declines in value in the multifamily space, and it's because hedge funds are returning keys, right? We've seen it in the news, and what does that do to value? But here's my question for you, Tracey. If I'm a residential investor listening to this podcast, and I know that I could sell my residential unit because we're low inventory, like you just said, it's a strong seller's market.
Yes.
And as we see the erosion on the commercial side, I do believe that will continue. And I see opportunities there, and I want to roll from residential into commercial, take advantage of both markets.
Yep.
Can I do that with a 1031?
Yes, you can. So the question always comes up, or a lot of people ask, they're called like-kind exchanges. In fact, it's written all over the tax code, like-kind exchange. It's somewhat of an unfortunate label, maybe even a misnomer of word. As long as what you're selling is real property held for investment or used to produce income. So any type of property, land, farm, ranches, in what we're talking about here, selling something residential like multifamily or single family rental houses, you can sell and you can exchange into any other type of real property that's held for investment or used to produce income. And that can indeed be commercial. You can sell your residential stuff, buy commercial stuff, whether it's retail or office building or whatever, it's okay. Like kind is, again, an unfortunate label in the tax code. Almost anything works to sell, almost anything works to buy.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
Look, I don't have a crystal ball. I've said that. You've said that. I don't know, but and I'm not trying to time the market, but what I can tell you is when we have months of inventory, under 2, which is our primary markets, Tracey, is Colorado and Minnesota, and it's under 2 in both those markets. That is a seller's market. There's no question about that. And we do see pain in the commercial. That's why I was asking the question. I do think that there's opportunity here.
Yeah, and it's not so much maybe even a crystal ball. It's the fact that you're just really relocating your money, relocating your asset that's producing income for you from one type of asset to another type of asset, going from residential over to commercial.
Yeah.
Perfectly okay. That's one of the big reasons to do a 1031. Besides,
so now's a good time, maybe.
And now is the time, very much so. Yeah, because capital gains effectively can be as bad as 30%. So you're avoiding the capital gains by doing the exchange, and you're relocating your asset to a much better product as well as geography. Going out of Colorado into someplace that's relatively more not quite as price elevated.
Yeah. Okay, so I want to dig into these 1031s, but you mentioned right before we hit record that you have some slides.
Oh, yeah.
So do you want to pull those up? We have maybe 10, 15 minutes here. So if we can cruise through your
remaining.
slides, but yeah.
Yeah, I'll cruise right through them. And in
So let's
fact,
go through those, and then I'll ask some questions as we go. But keep in mind that we have some people in the car right now listening. So
and they
let's
don't have the pictures. They don't have those visuals.
yep.
So
So
we will.
don't pull
Yeah.
over and don't start looking at your phone.
Do that for later on because it's being recorded, right?
That's right.
Okay.
And we will post this
So,
on YouTube. So there will be people listening or watching as well.
okay. So let me make sure that it's coming through in presentation mode. And again, I just fiddled with these slides right before coming on. So if they aren't picture perfect for movement, you can blame me later on. So 1031s are under, I think, enormous pressure. The administration has already tried to attack them 3 times so far in 2020, 21, and 22. In the State of the Union, and then the very next day with the OMB, they've said the following for 2024. They want to increase, for example, capital gains taxes. So let me explain capital gains for us in the real estate investment world. When you sell an investment real estate, like a rental house or like multifamily or commercial office building, you've got actually 2 gains. You've got the gain because it goes up in value, the appreciation, and that appreciation is taxed at either 15 or maybe 20%, depending on the client's adjusted gross income. But there's also, because it's investment real estate, a second gain. The gain because all those years that you've owned the property, you've taken depreciation as an expense, and that expense just builds up. It accumulates so that when you sell the real estate, that is a second gain that gets recaptured. It recaptures the depreciation. And no matter what your income level, it is taxed at 25%. So to paint a picture without the slides, we've so far talked about 15 or 20% on the appreciation, 25% now on the depreciation. Then on those 2 gains, there's a third tax, the net investment income tax. It's for the Affordable Care Act. It's an additional 3.8%, which, by the way, in the State of the Union, it was mentioned that they want to increase that 3.8% by a significant amount. And then the fourth tax is the state of Colorado at 4.4%. So let's just, again, for those folks that don't have a slide in front of them, we got 15 or 20 plus 25 plus 3.8 plus 4.4, 4.4, blah, blah, blah. It doesn't work that way. You just don't add up all those numbers. They blend together so that the effective rate for real estate investment sales is about 30%. But what they want to do is raise capital gains. So that means then that the tax on the appreciation part for people earning $1 million or more becomes ordinary income at 39.6%. Then they also add the 25% for the recapture depreciation and the 3.8 and Colorado's 4.4, meaning now, if this goes through, the blended or the effective rate would no longer be just 30%, but instead it would be about 45, maybe as bad as 50%. So that means 1031s are even more important. Then you wouldn't be just deferring 30%, you'd be deferring 45, maybe 50%. But here's the rub with all this. They're wanting to talk about, they have proposed, at one point in time, they actually proposed getting rid of 1031 exchanges. Now they've sort of backed off, and now they just want to limit 1031 exchanges. And what would that limit look like? They would let people do the exchange, but the maximum amount of gain that they would let you defer would only be $500,000 per person. So if it's a husband and wife, then you could defer a gain by doing a 1031 exchange of $1 million, $500,000 per person. But what does that impact if they severely limit 1031s? What's that impact on the economy and on us in the real estate world? Again, if you don't have the slides in front of you, I'll tell you what the impact is. When you talk about all residential sales, 1 out of every 5 sale, that's 20%, is driven by a 1031 exchange. Think about vacation homes, think about single family rental homes and rental condos. The switch over to commercial real estate. 1 out of 3 commercial sales is driven by a 1031 exchange. And in fact, IPX was a main driver in helping pay for a Big Four accounting firm to do a study on the impact of 1031 exchanges on the economy. And it turns out that 1031s are a huge boon, a very big plus to the economy. Specifically, it helps increase full-time jobs by 976,000 full-time jobs. It increases the income from those jobs, the labor earned, by an additional $48.6 billion. In other words, the total added value to this country's economy, to the GDP, is about $97.4 billion. Those are big numbers. That means 1031s are very important, not only to real estate, but to the economy as a whole. If they just limit 1031s to 500 grand, what do you think that would do to the residential market? What do you think it would do to the commercial real estate market, which is already in a world of hurt? It would probably seize up those markets. Okay, they also want to talk, or they also want to eliminate the step up in basis for those taxpayers that earn $1 million or more. So let me just explain this step up in basis. Maybe a lot of people know this, maybe not. And I have on the slides, if you get a chance to look at them, a property that you bought in, it's a rental property. You bought it for, I'm going to make up a number, 150,000. That's a little absurd in today's market, but it makes the math easy and the concept easy to understand. You bought it for 150 and now you're going to sell it for 200 grand. All right, so it's fairly straightforward. The gain is at least 50,000, probably more, because that basis of 150,000 has been shrinking by that depreciation. So, okay, here's the point of what I'm telling you about this step up in basis. You own this appreciated real estate, and if the owner should pass away, sad, but it does happen. When the owner passes away, there is a thing in the tax code, section 1014, that's called a step up in basis. What does that mean? That means that adjusted basis, in our example, 125,000, now steps up to fair market value, which is 200,000 on the date of that person's death or passing away, meaning that all of the gains are eliminated. They're erased. They're gone. So whoever the heirs are to the property, they could turn around and sell the property and they would pay zero capital gains. In our business, I'm sort of accelerating through the slides a little bit. In our business, I always tell folks, do the exchange. Don't pay the 30, maybe as bad as 40% in capital gains taxes. Just keep doing exchanges, because someday, when you should pass away, all those gains are going to be erased. And in our business, we call it swap till you drop. There's a little gallows humor right there. Let me finish out the story for the rest of the proposed tax changes, and then we can pick up where we left off in conversation, Kevin.
Okay.
They also want to increase the estate tax from 40 back up to 45%. They want to reduce, this is rather significant, the estate tax deduction. Right now, if you die and your estate is 11 million or less, there's no estate tax. They want to drop that down below the old $5 million number and down to just $3.5 million. So they want to reduce the estate tax deduction and increase the actual estate tax itself. And then I don't think I'm going to go through the rest of them. They want to increase the individual income tax rates, corporate income tax rates. I think that's enough for right now. I'll stop sharing the screen. I'll come back on and we'll take a look at each other.
This is super scary, Tracey. I haven't heard the one about the step up, the attack on the step up, because that's obviously super beneficial to an estate and to a family.
Yes.
And here's what I think. One strategy investors use for cash flow is to refinance or take out HELOCs, home equity lines of credit, and take on debt secured by the real estate. And the reason we like to do that is because it's cash in our pocket without paying any taxes. It's not income, it's a liability, right? So here's the problem with the step up. if we leverage a property, let's say it's fully depreciated and we got to recapture the entire thing, and we
But that
leverage
gets
that property
erased
up,
when they die.
right? But if they eliminate the step up,
Oh, yeah,
is
yeah.
what I'm asking. Now the
Yeah.
estate, there's a potential here. Here's where I'm going, Tracey. There's a potential that even if you liquidate the asset after paying off any debt that's in place, you might not have enough proceeds to even pay the tax on it.
That's exactly right. People would be forced to sell the asset. And this is why they put the step up in basis into the tax code way back in the early 1900s. You know, mom and pop owned a farm, they owned a little ranch, maybe they had a little small business. And when they passed away, the kids were forced to sell the ranch or the farm or the business simply to pay the capital gains taxes. And we're going back to that scenario. Very difficult, very
That's
hard on
significant.
people.
I can't.
Yeah.
I mean, look, we just talked about inflation and interest rates and the Fed trying to get the CPI and the PCE numbers under control. One thing that would work is to get rid of the 1031. Inflation would definitely come down if you did that.
No. Okay. What would really work is, I'm going so far off field. What would really work is if they quit spending.
No, totally.
You know,
I totally agree. And
six
you know
and a
they're
half
going to.
trillion. Yeah, our national debt's $34 trillion, for goodness sake. 1031s help increase the amount of taxes that the government actually receives, increases the amount of revenue that the government receives. So
I'm just saying, I put my conspiracy hat on.
I mean, I see. Okay.
You see, that would
that
fix
white
the problem,
hat went to
right?
a black hat and a little aluminum foil. Sorry. Okay.
That's funny. Okay, cool.
Ask
So
me some
we
more
are
stuff.
we are running short on time here, and I know we went through
okay.
a lot on the 1031s. But I want to make sure that we get, first of all, I want to make sure we get your contact information in case anybody has any interest in it. But is there anything else that we should know quickly, like in the next 2, maybe 3 minutes that you want to share with us about 1031s?
So first of all, my contact information, you can simply call me, 303-883-5846. If you don't get a hold of me, don't give up. Call my business partner, Danita, 303-242-6572. If you can't get either one of us and you've got a deal that's busting and you got to get it done right now, or you need a question like right freaking now, you can call our toll-free nationwide number, 877-775-1031. See, we got cute with the marketing there, 1031 on the end.
That's good that you got that number. That's pretty good.
Yeah. So is there anything else? Yeah, I think I'm pretty different than other qualified intermediaries. I will actually help you or the client figure out what their basis is, what their gains are, what their potential taxes are. I don't replace their CPA, but I help them understand what the heck is going on. And then they can go and talk and have a better, more informed conversation with their own tax advisor. So all that it's free. It's a part of our service. And when it comes to exchanges, we hold their hand through the whole thing from start to finish.
Yeah, and I know a lot of people that have used you because we've had a relationship for so long. Nothing but good feedback. So I will share that with you. It's been very positive experience. So and we talked about some pretty high level stuff today. Some of the laws that might be hitting. We talked about the step up. That's huge. The limitations to the 500,000 sounds like very similar to the numbers on the tax exempt amount on the gain on your primary home. So maybe that's where they're getting that from. So it's a lot to unpack, a lot to navigate through. So definitely give Tracey a call if you have any questions about it. But I do believe now is a good time to potentially use this strategy, the 1031 strategy, because we're at a good time to sell residential real estate.
Well, like you brought up earlier, it's time to move your assets from a underperforming asset to a better product, different product, and to move it geographically. So you're exactly right. 1031s are the tool, about the only tool that you can actually do that with.
Yeah, and I can't see totally clear, and I'm not trying to time the market, but it just seems like now's a good time to sell one asset and buy another. It just feels that way.
Oh yeah, I would agree. Yeah.
Okay, so we're going to wrap it up here. Tracey, this is your first time on the Real Estate Educators podcast. I know it went super fast because we have so much to talk about, and you're so knowledgeable. So I apologize. We have to cut you short. I know you have
It's
a lot
okay.
more that you could share, but we do try to
Janita
keep it
says I
to
love
30
the sound of my
minutes.
own voice, so it's okay.
Well,
You
you
can cut
definitely
me
know
off.
what you're doing, and it's definitely fun to chat with you. So I'm going to say
Likewise.
thank you to you, Tracey, for giving me 30, 40 minutes of your time, helping me, helping our listeners. And the listener, I know you got some value out of this one. We went a little higher level today, but it's very, very valuable. So help me out. 5-star review, share it with your friends, and I hope you make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.